Hello, everyone. This is John Muntz with Dealer's Edge. I want to welcome you all to our ongoing series of workshop summaries in which we take one of our full length online workshops and produce a shortened video summary of the material provided. We typically host 3 to 4 full length workshops a month that usually run about an hour's time. In case you haven't heard of us, Dealer's Edge is a firm dedicated to informing dealers and dealership management on topics relevant to your bottom line. We are always producing new content via our online workshops, webinars, books, manuals, and summaries. For this summary, we are talking about theft and embezzlement within the dealership and internal controls to combat them. Our experts are Jeremy Epstein and Maya Sutanto with Crow LLP. Dealer's Edge members have access to the full 1 hour workshop as well as the executive summary in PDF format, which is what is being read here, not to mention hundreds of other topics targeted to dealership owners and managers. Rob Keeley, an industry expert himself, wrote the summary, and the narration is done by Darius Jackson. Relevant links will be in the description below. Please remember to like, comment, and subscribe to stay informed of new releases. So, all that aside, let's get into it.
Dealer's Edge, Executive Summary, Internal Dealership Controls to Prevent Theft and Embezzlement. Auto dealers are routinely surprised and shocked at how a trusted employee could have stolen so much without obvious detection. Don't be blindsided. Most employee embezzlement is the result of not paying enough attention to exercising common sense internal controls. Dealerships handle a lot of money, providing ample opportunity for stealing. What can dealers do to keep ahead of these thieves? Jeremy Epstein, CPA, CFE, CAM's Senior Director, Forensic and Investigation Services Practice, and Maya Sutanto, CPA Managing Director, Retail Dealer Practice from Crow LLP, joined us for an online workshop to share their thoughts on how to keep honest people honest and prevent theft and embezzlement. Crow, www.crow.com, is a public accounting, consulting, and technology firm that combines deep industry and specialized expertise with innovation. By listening to our clients, we learn about their businesses and the challenges they face. Our dedicated team strive to deliver exceptional client service while upholding our core values and strong professional standards. We invest in tomorrow because we know smart decisions build lasting value for our clients, people, and profession. This report is a summary of Jeremy and Maya's comments and suggestions. There is no greater fraud than a promise not kept. Scottish proverb. This frank discussion is about the risks auto dealerships face and how to both identify and prevent otherwise good employees from stepping over the line. The takeaways from this workshop are: understand the extent and negative financial impact of fraud and employee theft to your business. Review areas of dealership where internal controls are needed and gain an understanding of how internal controls can help prevent fraud. Understand the best practices of internal investigations. Analyze real-life dealership fraud schemes, including how the fraud was detected, what investigation steps were taken, and lessons learned. Understand key fraud prevention and detection techniques. Today's agenda is Impact of Fraud. Fraud and employee theft on the rise. Fraud 101. Detection of fraud. Recent statistics and methods. Retail dealership fraud schemes. Case background. How it was uncovered. Investigation steps. Prevention of fraud. Impact of fraud. When it comes to fraud, it is a sad occurrence when it happens to the other guy. But when it happens to us, it is a tragedy. But how big of a problem is it really? It's bigger than you might think. The cost of fraud. The cost of theft and embezzlement is estimated to be $7 billion plus in 2017, up from $6.3 in 2016. But those are only the ones we know about. It is estimated that most cases go unreported. 55% of known cases cost less than $200,000, while 22% are more than $1 million. Organizations are estimated to lose 5% of annual revenue to fraud. Payment fraud affected 78% of organizations in 2017. Check fraud, 74%. Wire transfer fraud, 48%. Corporate card fraud, 30%. But to add insult to injury are the hidden costs on top of the actual financial loss. The hidden costs of theft. Consider the aggravation and lost production caused by police reports and potential prosecution. Internal investigations and their impact on the employee morale. Legal representation, affidavits, and other legal documents. Negative publicity and loss of stature with the public and business community. It's no wonder that many victims don't think it's worth the trouble. And per the 2018 ACFE report to the nations, reports to law enforcement have fallen to 58% in 2018 from 69% in 2008. And don't count on the insurance to make you whole because 53% of known cases recover nothing from insurance/perpetrator. 32% make a partial recovery from insurance/perpetrator. 15% recover all losses from insurance/perpetrator. And your premiums go up. Wow. So how do I prevent fraud in the first place? It starts by knowing what you're dealing with. Fraud 101. Occupational fraud is fraud committed against the organization by its own officers, directors, or employees, and is generally grouped into several categories. Thieves will often employ several types of fraud when perpetrating their schemes. Categories of occupational fraud. Asset misappropriation, 89% of known cases, and is the least costly type of fraud. Median loss, $140K. An employee or official steals or misuses the organization's resources. Example, theft of company cash, false billing schemes, or inflated expense reports. Financial statement fraud, 10% of known cases and the costliest type of fraud. Median loss of $800,000. An employee or official intentionally causes a misstatement or omission of material information in the organization's financial reports. For example, recording fictitious revenues, understating reported expenses, or artificially inflating reported assets. Corruption, 38% of known fraud cases. Median loss of $250,000. An employee or official misuses his or her influence in a business transaction in a way that violates his or her duty to the employer in order to gain a direct or indirect benefit. For example, schemes involving bribery or conflicts of interest. Asset misappropriation. Common fraud schemes. Cash schemes. Fraudulent disbursements. Billing schemes are 20% of known causes and average $100,000. Payroll schemes. Expense reimbursement schemes. Check and payment tampering are 12% of known cases and average $150,000. This is a significant problem for auto dealers due to weak bank reconciliation processes, inadequate segregation of duties, and allowing safeguarding of cash and checks to be ignored. Registered disbursements. The employee makes false entries on a cash register to conceal fraudulent removal of cash. For example, voiding a sale. Skimming is 11% of known cases and averages $50,000. Incoming payment is stolen before being recorded in the GL. For example, accept a payment and not record it. Sales, receivables. Larceny. Petty cash is 15% of known cases and averages $20,000. Deposit theft. Incoming payment/deposits is stolen after it has been recorded in the GL. For example, steal cash, check from the receipts before they go to the bank. When asked about the wisdom of tasking service advisors with cash duties, Maya noted that this is becoming an ever more popular customer relationship tool and should not pose significant risk so long as cash and credit card refunds are handled by a third party. Inventory/non-cash schemes are 21% of known cases and average $98,000. Larceny. Theft of inventory, unrecorded or understated sales, etc. Misuse. Demos, rentals, used vehicles, shop equipment, etc. Motivations to commit fraud. The fraud triangle helps explain why employees commit fraud. Pressure. Reduced income. Medical or other bills. Expensive tastes, addiction problems. Opportunity, weak internal controls, reduced employee counts, poor management oversight. Rationalization, borrowing and fully intends to pay back. Job dissatisfaction, therefore something is owed to him or her. Justified, to save family, home, car, etc. doesn't understand, or doesn't care about the consequences of their actions. So what type of people tend to commit fraud? The ACFE offers some insight. Profile of occupational fraudsters. Average employee profile in a typical organization is 30% are honest, 30% are dishonest, 40% will commit fraud if the conditions permit. Males between the ages of 31 and 45. Men commit 75% larger financial frauds than women. Who commits fraud? Employee, 44% of fraud. Manager, 56%. And they are 3 times as costly as an employee. Most common behavioral red flags include living beyond one's means, 41%. Financial difficulties, 29%. Unusually close relationships with vendor or customers, 20%. Excessive control issues / unwillingness to share duties, 15%. Divorce/family problems, 14%. Wheeler-dealer attitude involving shrewd or unscrupulous behavior, 13%. Fraudsters exhibit at least 1 red flag in 85% of cases and 2 red flags in 50% of cases. Red flags vary by gender and position within the company. Only 4% of identified perpetrators had been previously convicted of a fraud-related offense. This may be because they have not previously perpetrated fraud or just have not yet been caught. Only 8% were previously fired for a fraud-related offense. Other important fraud statistics. Median duration of a fraud scheme is 16 months. However, many go on for years. Fraudsters tend to work in areas that have access to financial systems and controls, such as accounting, 14% of cases, median loss of $212,000. Operations, 14% of cases, median loss of $88,000. Sales, 12%, median loss of $90,000. Executive management, 11%, median loss of $729,000. Admin, 8%, finance, 6%, purchasing, 5%, maintenance/inventory/IT, 3%, marketing, 2%, production, 2%, HR, 1%. Weak/non-existent controls enabled 50% of fraud incidents. Small businesses are twice as likely to experience fraud and suffer the largest losses, averaging $200,000 because of lack of segregation of duties, non-availability of resources for anti-fraud controls, no internal audit, increased level of trust throughout the organization. Legal elements of fraud. While we may think we know fraud when we see it, it does in fact have specific legal descriptions. Sometimes what we think is fraud is actually negligence or non-compliance on the part of the employee. When asked what the difference is between fraud and embezzlement, Jeremy noted that while there is a slight legal distinction, the methods of investigation and prevention are the same. Black's Law Dictionary, 10th edition, 2014, defines fraud as a knowing misrepresentation or knowing concealment of a material fact made to induce another to act to his or her detriment. A reckless misrepresentation made without justified belief in its truth to induce another person to act. A tort arising from a knowing or reckless misrepresentation or concealment of material fact made to induce another to act to his or her detriment. Forensic accounting, fraud investigations. AIPCA, BVFLS, Practice Aid 0701. Under common law, 3 elements are required to prove fraud. A materially false statement or omission of material fact made with an intent to deceive, orally or in writing. Knowledge by the perpetrator that the statements or omissions are false and misleading. Intent for the misrepresentation to be acted upon. Reliance by the victim on the statements. Damage to the victim who relied upon the statements, actual or punitive. Managing the business risk of fraud, a practical guide. Fraud is any intentional act or omission designed to deceive others, resulting in the victim suffering a loss and/or the perpetrator achieving a gain. Operative terms. A knowing misrepresentation. A reckless misrepresentation made without justified belief in its truth. Any intentional act designed to deceive. Detection of fraud. The most crucial moment in the fraud examination process is the initial detection, as it can close or open options for an organization. How fraud is initially detected. Source 2016 to 2018 ACFE report to the nation on occupational fraud and abuse. This graph ranks the methods by which businesses initially learn that they are victims of fraud or have a problem. For years, tips have been the most common detection method, with 53% from employees, 21% from customers, and 8% from vendors, and 14% from anonymous. This suggests reporting mechanism should be accessible to not only employees, but outside parties with the ability to stay anonymous, if legally permissible. Important to note that businesses with fraud hotlines reduce fraud losses by 50%. Management review. Internal audit is now a more common detection method than management review. Employee exit interviews are another way to learn of any issues. So now that you have become aware that someone is dipping into your pocket, what do you do with that information? Investigation considerations. Do not succumb to the temptation to confront the perpetrator and put them on notice. This can set in motion unhelpful events such as financial distress to the dealership and/or victim. For example, loss/cost of investigation, loss, destruction of business records, regulatory action/attention, emotional baggage/internal finger pointing, negative publicity/public perception. So if you are reasonably certain about the facts of the fraud, who do you consult and notify? Internal investigation steps. Since this is a technically challenging environment, consider retention by counsel to establish confidentiality and privilege, establish work plan, scope, division of procedures with counsel, protect witnesses, preserve and document close coordination with counsel. Consider placing suspects on paid/unpaid leave of absence to reduce their ability to alter or destroy evidence. Seize electronic devices, laptops, PCs, cell phones, tablets, etc. Conduct as needed background searches on the suspect, searches of their workspace, offices, etc. Forensic accounting, forensic data to find deleted files, etc. Surveillance of the suspect, associates, lifestyle, etc. Handwriting experts. Retail dealership fraud schemes. It is important to note that every employee in these fraud schemes are long-time employees and that the fraud loss was never 100% recovered. Case study. Segregation of duties. Case background. A controller embezzled more than $10 million from a dealership via approximately 800 wire transfers over a 6-year period to personal bank accounts and covering up the transfer of funds by falsifying inventory records and bank statements. How it was uncovered. The controller quit after the CFO started questioning some of the controller's accounting and confessed to the thefts to the U.S. attorney shortly thereafter. It's not clear how much management knew of the thefts at this point. The controller had personal problems, which resulted in compulsive behavior, including excessive spending, shopping, and gambling. Investigation steps. The wire transfers were made from the operating account to the payroll account and then to the personal bank accounts. Accounting records and bank statements provided to auditors were altered, including putting sold vehicles back onto inventory reports and falsifying floor plan loan documents. A different set of reports would be provided to management. The controller pleaded guilty to wire fraud and cooperated with the investigation and was sentenced to 78 months in prison and ordered to repay the dealership $10.3 million. It was expected $1 million was recovered immediately. Lessons learned. Proper segregation of duties. Wire transfers and EFTs use. An authorized vendor list. Positive pay. Independent review of payroll. Callbacks. Someone independent conducts the bank statement process review. Receive bank statements directly. Segregation of duties between bank records and payments. Independent review of bank, floor plan, inventory reconciliations. Include these reviews in the management reporting month-end package. Inventory observation conducted monthly and reconciled to the general ledger and reviewed by someone independent of the process. Establish a hotline. Establish a code of conduct. Internal audit procedures including data analytics. Bank statement controls. Review of reconciliations and general ledger and controls around general journals. Monitor using data analytics of payments, including wages, reserve accounts, etc. Caution. Financial statement audits do not express an opinion of the effectiveness of internal controls. Case study. Vendor payments. Case background. Assistant controller embezzled $2 million from a dealership over 7 years by creating fraudulent records to support payments to non-existent parts vendors. This owner stressed that it was important that they go to jail, so they don't do it somewhere else. However, it is common for dealers to not prosecute. They file an insurance claim, and move on. How it was uncovered. The owner and the service manager noticed gross profits weren't as high as they should be based upon number of ROs and discovered the fraudulent payments, which led to the assistant controller being fired. Investigation steps. An investigation was conducted and the assistant controller was prosecuted, pled guilty, and sentenced to 8 years in prison. $850,000 of assets were recovered. Some funds were recovered from banks and an insurance claim, and the assistant controller was to pay restitution of $572,000. Lessons learned. Maintain an authorized vendor list approved by management. Verify vendor payments against this list. Access to master vendor lists should be restricted and monitored regularly by someone independently. Proper segregation of duties around vendor payments. Factory payable reconciliation should be properly reviewed and supported with properly authorized purchase orders. Establish a hotline and code of conduct. Internal audit procedures, including data analytics. Case study. Sales incentives. Overstatement related to certain stair-step incentives and finance and insurance, F&I, rebates from the vehicle manufacturers. Case background. Sales incentive receivables were overstated by $1.3 million at 5 dealerships. How it was uncovered. During a year-end analysis, the dealer discovered factory rebates, co-op, sales volume, and CNA incentive accounts receivables were overstated. Investigation steps. Crow investigators determined whether any potential write-offs could be identified or whether there were any indications that employees inappropriately benefited from dealership transactions and/or the previously identified write-offs. Performed variance analysis between budgeted and actual amounts. Conducted interviews of various dealership personnel. Analyzed month-end reconciliations for aged, unusual, or uncollected amounts. Ran an anomaly detection tool to identify anomalous entries. Lessons learned. Sales and accounting personnel colluded to manipulate incentives to increase bonuses. Employees attempted to kite overstated incentives previously posted to different control numbers to conceal new incentives. Dealer wrote off the overstated receivable accounts after the investigation. Perform periodic GL analysis to identify anomalies. Institute management reviews. Case study. Fictitious sales. Case background. Increasing revenues and decreasing cash from the body shop. The AR clerk stole cash deposits from the body shop by not recording the sales in the general ledger. How it was uncovered. The supervisor of the body shop provided cash and credit card receipts to the office manager when the AR clerk was out of the office. The office manager noted that the amount of cash was higher than the normal for the body shop. Investigation steps. Placed AR clerk on leave and compared sales in the point of sale system for the body shop with sales recorded in the general ledger. Identified whether there were any indications that employees inappropriately benefited from cash transactions. Lessons learned. Lack of reconciliation between point of sale system and general ledger. Don't assume that a trusted employee or friend will not cheat you. Conduct open RO reviews. Case study. Extended warranty fraud. What is it? Dealership sells a new or used car, providing an option for the customer to purchase an extended warranty plan offered by a manufacturer/third party. When a customer has service and the needs are covered by the manufacturer/third party's extended warranty, the dealership electronically files a claim with the manufacturer/third party and receives the manufacturer/third party's approval, if over a stipulated dollar amount. Warranty claims below the established thresholds did not require the manufacturer/third party's approval. The manufacturer/third party ultimately will pay the dealership for the agreed upon price for parts and labor related to that service, based on a stated warranty service labor rate provided by the manufacturer third party. Therefore, if the fraudulent claims were submitted to a warranty company, the incremental increase in the operational results would directly benefit the service and parts department managers. The alleged fictitious claims serve to artificially inflate the revenue and profitability of the dealership and thereby increase the general manager's bonus. Case background. Fraud was perpetrated by multiple employees at the dealership, including service technicians and service advisors. The perpetrators filed false manufacturer/third-party extended warranty claims for many years by adding fictitious work items to the repair order and inflating hours. How it was uncovered. The scheme came to the attention of the dealership ownership group after being contacted by a manufacturer due to a large quantity of warranty claims. Investigation steps. Service advisors, SA, and service technicians, ST, were paid on a flat rate hour and not on a rate per hour worked basis. Therefore, SAs and STs were paid based upon the contracted hours worked on a service repair order, RO. The more flat rate hours SAs and STs could designate to an RO, the more they were paid. If an SA or ST added fictitious lines, such as the alleged fictitious extended warranty claim work, to a legitimate repair order, this would increase the total amount of flat rate hours related to the work order, which would increase the amount paid to the SA or ST. Lessons learned. Perpetrators were motivated to commit the fraud based on their incentive structure. Service and parts department managers actively involved in the day-to-day operations of their departments were paid based on their respective performance. General manager was paid a bonus based on the dealership's profitability. Tone at the top issue. Local dealership management knew about the practice at the time of discovery. Conduct independent RO reviews. Prevention of fraud. So how do dealers prevent fraud from occurring and catch it when it does? Identify key fraud risks and indicators. Problem areas are often overlooked in dealerships. Perform an internal self-diagnostic to assess your risk level in each of the key control areas. Have different personnel identify differences in the understanding of your dealership's internal controls. Design internal controls. List of strong internal controls. Monitoring techniques which can be implemented/performed. Other fraud detection methods. Anti-fraud controls, impact on fraud loss and duration. The attached table lists key anti-fraud controls and their relative effectiveness. The red font highlights controls that generate some of the largest loss reductions, as well as controls that have the largest reductions in fraud duration. For example, a code of conduct has the most impact on fraud loss, and proactive data monitoring/analysis has the most impact on fraud duration. Problem areas often overlooked in dealership. User access. Areas of abuse. Terminated employees still have computer access. Off-hours access to computer systems. Conduct audits of at least the critical screens. All DMs can produce user access reports as needed. R&R/6220 report. CDK can do by function. Have a system in place to add/remove users, for example, HR notification. General journal entries. 27% of cases use fraudulent GJs to cover up fraud per 2018 ACFE report to the nations. Have mitigating controls in place. Example, if a lot of people must have access to the GJ, then make sure a proper review process is in place. General journal copies are numbered, for example, number 1, number 2, etc., so that the total population is accounted for. Limit GJs to corrections, write-offs, unusual items only, and require documentation to support all adjustments. Limit access whenever possible. Conduct independent GJ reviews. Finance and insurance chargebacks. Ensure that they relate to contracts of the dealership and are properly calculated. Repair order discounts. Discounts should be monitored daily, as most service advisors can give them without approval or documentation. Understand who has access to voiding ROs. Should only be the service manager/accounting if it is needed at all. If not really needed, then the function should be turned off. Review open repair orders, aged, voided ROs. Policy adjustments, service and body shop. Policy adjustments should be supported and properly approved. Investigate patterns or trends. Extended warranties and warranty claim rejections. Ensure that fictitious lines are not added to ROs. The warranty claims administrator should be performing audits. Purchase orders, vendor payments, use of EFTs and positive pay. Parts inventory testing, override adjustments, test counts by outside party, voiding to refresh aging. So what internal controls should be in place? Strong internal controls. The benefit of internal controls is that they prevent as well as detect fraud. They also address regulatory, legal, compliance issues in addition to deterring employee theft. They are only effective if properly designed, and you need to inspect and test that the controls are working effectively. Some common controls are segregation of duties, bank reconciliation and check signing/access to EFTs. Controller/office manager should not be the DMS administrator. Accounts payable clerk should not have access to the cash reports. Accounts receivable clerk should not have access to general journals. Limited access to general ledger. Limited access to payroll system. Anonymous employee hotline. There are third-party vendors who offer this type of support. Mandatory vacations. Authorization limits. Positive pay. Dual signature requirements. Fully supported journal entries and account reconciliations. Physical security of cash, inventory, and other assets. Online security. Phishing training and compliance. Patching, antivirus, spam firewall, website access control. Periodic computer and email password changes. Intrusion prevention system. Cyber insurance policies to protect against liability. Techniques not normally thought of. Due diligence of vendors and suppliers. Is pricing in line with fair market value? Are vendor W-9 forms on hand to ensure that they are legitimate and registered with the IRS? Include contract clauses granting you the right to audit. Employee background checks. 48% of organizations do not run background checks per 2017 ACFE report to the nations. There are complex state and federal regulations that need to be complied with, so ensure proper training and legal counsel to review policies around the hiring process. For example, some states require background checks be completed after the interview. If a negative report is received, consider age/time since conviction, evidence of rehabilitation. If rejected because of background check, report must be provided to candidate so can have an opportunity to dispute the results. Prosecution of offenders to send a message to potential fraudsters and to ensure that thieves do not cheat someone else. Monitoring techniques, machine learning, data analysis/data anomaly detection, digital forensics, e-discovery. Using data analytics to prevent and detect fraud. Big data analytics such as this illustration are being harnessed to prevent and detect fraud. Jeremy recommends that they be run at least annually to pick up on trends and outliers. So how are they used? Prevention techniques, access control, transaction limits, authorization requirements. Detection techniques, Benford's law. The principle that in any large, randomly produced set of natural numbers, such as tables of logarithms or corporate sales statistics, around 30% will begin with the digit 1, 18% with 2, and so on, with the smallest percentage beginning with 9. The law is applied in analyzing the validity of statistics and financial records. Data mining, pattern analysis, transaction logging and alerting, business intelligence, BI. When asked if there are fraud, analytic/detection tools that integrate into dealerships' DMS systems, both Jeremy and Maya confessed that they are unaware of any. They noted that most tools run on other software platforms such as QuickBooks, etc. Conclusion. As with so many things associated with the internet and electronic data, the amount of fraud and the monetary damage that it causes is increasing. Fail-safes that worked in the past or could even be ignored are proving to be ineffective with significant and even embarrassing consequences, and prevention is needed now more than ever.
Okay, that's going to do it. Again, this was just a summary of the material provided. The full workshop goes into much more detail. Please check out Crow LLC at crowe.com. Our writer Rob Keeley's information can be found at fixedopsolution360.com. And to look into becoming a Dealer's Edge member, it's dealersedge.com/VIP. All links will be below in the description. Please don't forget to subscribe as we have many more summaries on the way. This is John Muntz with Dealer's Edge saying goodbye for now.